Moving on to the next term, we're talking about Forex terminologies. In every field in life, there are terms, there are way people talk, in which as someone new into that field, you need to understand these terms so I can also be able to flow with the people in that term whenever they're speaking. So, what are terminologies? Terminologies is the body of terms used with a particular technical application in the spirit of study, proficiency. So terminologies is the way people speak in a particular profession, the language of that profession. So in Forex, we also have our own terminologies. Now, what the importance of you knowing terminologies is that whenever you're around traders, you can be able to speak with them. Okay, so let's get to business. The bulls and the bears. The bulls are referred to as the buyers in the market, while the bears are referred as the sellers in the market. So basically, when someone says the bulls were in the market, the person literally means the buyers were in the market. And when someone said we experienced lots of bears, that means there were more sellers in the market. Right? On to the next. The terminology are quite very simple and easy to understand. Bullish and a bearish market. Just as the bulls mean, a bullish market is a market that is going upward, and a bearish market is a market that is going downward. So when they say we have a bullish market, you understand that the market is going up. It's referring to the upside. And when you say the market is, you have a bearish market, it simply means the market is going down. Okay? On to the next. To go long and to go short. To go long means to buy, and to go short means to sell. So when someone said I went long on Euro USD, the person simply means he bought Euro USD. He or she bought Euro USD. And when someone said I went short on Euro USD, he or she meant he or she sold Euro USD, alright? Quite easy to understand. Trading and arranging market. Trading market is a market that has direction. That is either going to the upside or down or the outside. While arranging market is a market that moves sideways. The arranging market is in a correction phase, it just keeps going sideways. While a trending market is either moving upward or downward. Bid and ask price. The bid price, this is the price that you are willing to buy a currency. Is a price in which the sellers are willing to buy a currency. Okay? How the ask price is the price at which you are willing to sell the currency. Is the price in which the sellers are willing to sell a currency to a particular person. Okay? The bid price is the price in which the buyers are willing to buy a currency, while the ask price is the price in which the sellers are willing to sell a currency. It's quite simple and understandable. Based on quote currency. The base currency. This is the first currency in the currency pair. We talked about this in our previous video. The base currency is the first currency in a currency pair, while the quote currency is the second currency in a currency pair. We want to see this. For example, in Euro USD, Euro is the base currency. That's why it's the first currency in the currency pair. And then USD is the second currency, which is going to be the quote currency. Okay? NFP, an acronym for non-farm payroll. So when someone tells you what NFP is an acronym for non-farm payroll. Now, what's non-farm payroll? Non-farm payroll is a very important news event in the US. This will be discussed later on during the training. As we go into the training, we'll still be talking about this NFP. NFP is an acronym for non-farm payroll, a very important news event in the US. This will be talked about later on during the class. Spread and PIB. Spread is the difference or gap between the bid price and the ask price. That's the spread is the difference or the gap between the price in which buyers are willing to buy a currency pair and the price in which sellers are willing to sell a currency pair. So if the buyers are willing to sell at this particular amount, okay, let's simple example. If the buyers are willing to buy at 1 and the sellers are willing to sell at 2, at 3. So spread is the distance. When you do 3 minus 1, you have to what? So that means that 2 is the spread. Spread is the difference or the gap between the bid price and the ask price. PIP, percentage in profit. PIP is a short form of percentage in profit. Is the measurement to show the change in value between two currencies. The PIP is the measurement to show the change in value between two currencies. So what they say on Euro USD moved from 1 to 3. PIP is 3 minus 1, that's 2. Is the measurement that shows the change. 2 is the change. 2 is the increment that Euro USD moved from 1 to 3. Okay? No, not the difference between this term. Spread is the difference or the gap between the bid and ask price movement. Pip is the measurement that shows the change in value between two currencies. Okay. Lot size. Lot size is the position size you take on the market. The position size you take on the market determines the size of your profit and losses in dollar value by affecting the value of a single pip. So basically, lot size is the position or the quantity in which you buy a particular currency pair. This will also be explained in our classes, subsequent classes. We're going to talk about lot size. Most of these terms will be expanded in our subsequent classes. So just get a hint. Just a hint on what you're talking about. Let's see next, technical fundamental analysis. Technical analysis involves poring over charts to identify patterns or trend. Reading the chart, which we're going to talk about in class, what's the Forex chart. Technical analysis involves poring over charts, going through charts to identify the patterns or trend. Alright, fundamental analysis involves poring over economic data reports and news headline to know the strength of the currency. Why technical analysis involves going through charts, looking at past data to identify similar patterns or trend. Fundamental analysis involves looking at the economic data report. What is the country saying to determine the strength of the currency? A Forex broker. Who is a Forex broker? A Forex broker is a financial service company that provides trader access to a platform for buying and selling currencies. So the Forex broker is a financial service company that provides trader access to the platform for buying and selling foreign currencies. So the Forex broker are the platform that gives you access to the forex market. They gives you a platform. They provide you access to a platform where you can buy and sell currency. That's what the Forex broker is. It will also be defined more expanded in subsequent classes. Alright. Leverage and margin. Leverage is the ability to use something small to control something big. Note the difference. Leverage is the ability to use something small. For example, using $100 to control something worth $1,000. So leverage is the ability to use something small to control something big. What is margin? Margin is the capital you use to open or maintain a new position when trading. Margin is the capital you use, the amount you're using to open. The capital you have to have specific money in your account for it to open or maintain a new position when trading. So that capital you have to use to maintain that position is what we call margin in trading. Moving on to the next. Liquidity and volatility. Liquidity describes the extent to which an asset can be bought and sold quickly and at stable prices and converted to cash. How quick can this asset be bought? That's what we call liquidity. So when someone says there's no liquidity in the market, that means that the market, you can't buy this thing because there's no liquidity. You can't buy it very fast. So liquidity describes the extent to which an asset can be bought and sold. Okay? Note the difference. Volatility is a measure of the amount by which price fluctuates over a given period. In forex trading, volatility measures how large the upswing and downswing are for a particular currency. When liquidity is how fast can an asset be bought and sold quickly and at stable prices and converted to cash. While volatility is the measure of the amount. With quantity of the amount that price fluctuates at the given period of time. What's the quantity? Is how large is this upswing? That of volatility. Liquidity is how fast can it be sold or bought at stable prices. Okay. Demo and real account. A demo account is an account that allows you to learn about the mechanics of forex trading and test your trading skills with zero risk. Yes, that's right, zero risk. It's a demo account. Demo account is an account that allows you to learn. You practice, like kind of a practice account. It's not even it's a practice account. It's where you go to practice your skill and knowledge. For example, after learning from us at Forex Mastermind, you don't just jump into your real account. You get a demo account for you to practice. You practice your skill with zero risk. In this case, there's nothing to lose. The only difference between demo and the real account is that on the real account, you trade the real money. That's to say, it's 100% risk attached. Whatever profit you make is real money. Whatever loss you take is also a real loss. While on a demo account, there is no risk attached. 100% zero risk. The demo account is where you practice. You don't practice on your life account. Alright, you practice on your demo account. Moving on to the next. Stop loss and take profits. Stop loss and take profits. Stop loss is the level at which a trader wishes to close a position. Stop loss is that level, that point which the trader wishes to close the position at a loss when the price gets to that level. So stop loss is the level which a trader wishes. At this point, I want to close this trade out in a loss. That's basically what stop loss means. It's the level the trader wishes to close the position at a loss, and when prices get to that level. Okay? Take profit. The difference with the opposite of stop loss is what take profit is. Take profit is the target level which a trader wants a position to be closed in profit when price gets to that level. So when stop loss is the position where, like, the level in which the trader will accept the loss, close out in loss. And take profit is where the trader wants to be closed in profit when price gets to that level. At that point, I want this market to take me out a profit. That's basically what take profit is. Stop loss, okay, if my analysis goes wrong, this is where I want to minimize my risks and minimize my loss. I have to stop me out at this level. Take profit, when my analysis goes right at this level, this is where I want to take profit. That's where I want to close the trade in profit. That was stop loss and take profit is, okay? Risk to reward is a very, very important thing in Forex. So risk to reward ratio, in other words, RR, is the difference between the amount of money you are willing to lose relatively to the amount of money you are willing to aim to make. Risk to reward is the difference between the amount of money you are willing to lose. I'm willing to lose $1 to make $5 to make $10. That's what basically what risk to reward is. I'm willing to lose $100 to make $500. Basically, what risk to reward is that I'm willing to lose $1 to make $5. That's 1:5 RR. That means I receive 1% of your account to make 5% of your account. That's what we call risk reward. The amount, the difference between the amount of money you are willing to lose relatively to the amount you are aiming to make. Note this: the amount you are willing to make should be bigger than the amount you are willing to risk. It's a very, very important thing that every trader needs to know. If I want to make $10, if I want to reach $10, then I should probably be targeting make $20 or $15. That's basically what it is. Okay. And with that, we have come to the end of this session. We move on to the next stage.